Hey, everybody, welcome back to another episode of the Wisconsin Investor. Super excited for today's episode. I have my good friend, my accountant from Clifton Larson Allen, Mr. Jake Caelwaerts, joining me. Jake, what's up, man?
Not much, Corey. How are you doing?
I'm doing good, brother. I'm doing good. At the time of this recording, we're past the bulk of the tax season, so I get a little chance to sit down and chat with you, man, which is always great. I know you're always slammed for the first half of the year, it seems like, but let's dive right into it, Jake. Why don't you tell the audience a little bit about you, what you do, and your background? How did you get into the spot you're in now in the accounting space?
Yeah, so as Corey mentioned, Jake Caelwaerts, a principal over at CLA in our tax department, and focus really on real estate and construction clients here at the firm. Um, really got into it. It's kind of a funny story. I just watched some of my friends really start investing in real estate when they were, getting out of high school, and I thought it was really something relatable that I had a group of friends that were doing it. So discussing tax and items with them. Why not bring that, to clients? And it really got me excited. Um, so that's kind of how I got into real estate, and just yeah, the last 8, 9 years now have been a good roller coaster of
Okay.
expanding client base and so forth. So look forward to talking some tax things here today and see where the conversation goes.
Yeah, and before we get into that for a second, just because my personality is probably a little bit different than yours, you said you got excited about accounting when it came to real estate. Tell me what do you mean by that? What was exciting about accounting and real estate? It's a hard concept for me to fathom.
Well, there's a law of large numbers, right? I mean, in real estate, you can see net worth and wealth generation quite
Okay.
quickly. I think that really excites probably a lot of investors and why they're doing what they're doing. So yeah, accounting. I mean, I'm a numbers guy, math. That just goes hand in hand.
Right on. Okay. That makes more sense. All right. I just had to ask because accounting to me is not fun. However, I will say what is exciting to me and what I love talking to people about, and I'm excited to have you on here, is not paying taxes legally. That to me is one of my favorite things in the world. And so I love when we get to sit and talk strategy and talk about like you bring new concepts to me sometimes, and I'm like, what? I had no idea that you could do this. So let's dive into some of those topics if you don't mind, Jake. Let's talk a little bit like if I'm a budding real estate investor, somebody looking to get into real estate, like what are some things I should be thinking about on the front end to set up my tax strategy as I'm diving into this and maybe making this a longer term type of a career I want to get into, maybe, or just investing strategy? What are some things you can see some of your most successful people should do on the front end?
Yeah, that's a great question. I think number one, you always want to start out keeping it simple and understanding really your intent of what you're trying to accomplish with your real estate portfolio, or whether it's flips or long term holds. And I jotted down understanding cash flow. You guys obviously vet deals and understand when you're looking to acquire something, whether a deal is a good deal or not. But also kind of flipping that over to the tax side and understanding your taxable income or your taxable loss,
Okay.
and how lenders view that. So kind of from a starting point, you really want to understand both items and understand how your tax return is going to be viewed, from a lending capacity, or all the way down the line,
Okay.
ultimately to what you're paying in taxes.
Yeah.
So I think just understanding that full picture from the front, from the start, is crucial.
So when you
In
say that
understanding.
understanding what the lender is looking at, what are some things you mean by that? Can you expand on that a little bit?
Yeah, I mean, one big item that you guys are going to see is depreciation, right? When you acquire that building, you're going to start writing off or deducting the cost of the building. A lender is going to typically add back those depreciation deductions in reviewing what your true cash flow is when they're looking to lend, on the net income or the cash flow of the property.
Right on. So they're going to see a loss on that. Maybe let's say even the property is a loss, but when you add back depreciation, you're actually positive cash flow. They factor that in on the lending side, is what you're saying.
Correct. Yeah,
Okay.
and even think about repairs. There's items that, from a tax standpoint, you can be aggressive on and deduct instead of maybe capitalizing and depreciating. If those are one time, not reoccurring, calling those out and being able to call those out and know what the details are is going to provide a much more fluid conversation with the lender.
Do you mind if we dive into that quick, Jay? Because I didn't actually
Sure.
understand this. I've been investing now for like 7 years, and I don't think even up until recently, I just kind of like hand it the stuff to you. I have a bookkeeper; they do the books, and then I hand it to you, and then you guys figure out what to capitalize, what not to. I didn't know the implications of it. I'm like, oh yeah, let's capitalize it. But that's actually not what we want to do, correct? Because what is that? Can you explain what that means and
Yeah.
some examples
Yeah.
maybe?
So in you're looking at a general after you acquire a property and it's been placed in service, for its intended use. Let's just say it's a long-term rental, right?
Sure.
Typically, a lot of the repairs, whether reoccurring or not, might be able to fall into a repair expense. So you're not capitalizing and depreciating that cost.
So
Yeah,
you're
to your
taking the
point,
deduction
Cliff,
right away, and versus
correct.
having to spread it out.
So you're taking that deduction immediately in the year that it's incurred and paid. Prior to 2023, 100% bonus depreciation was in play for federal purposes. So for federal, you may have not got a different answer, right? You may have gotten to the same taxable income.
Okay.
But depending on what state the property is, not all states conform to that bonus depreciation that federal allows. So you might kind of have a whipsaw effect in for state purposes where now you're not getting nearly as much of that deduction. So yeah, to your point, a repair, an immediate write-off, both for federal and state purposes, is going to be a better tax answer
What
in the short run.
That's so good. What are some things that you see people typically maybe miscategorizing? Like they're popping it into capitalization, but if you want to be aggressive, again, I'm sure this is all dependent, and probably the disclaimer is, I'm not a CPA, you are, but like talk to your CPA, right?
Sure.
But what are some of those things you see if you had some example of that of like,
Yeah, I think unit turnover. If you have an existing rental property that you're just changing tenants over, think about some of those maintenance items that you're going to attend to get the new renter in. A lot of times those items can be expensed. There was a pretty big overhaul in 2014 or 2015 with the repair regulations
okay,
that you can look at what a unit of property is. One example maybe tends to lean towards a little commercial, but an easy one would be, if you have a commercial building that has 10 HVAC units on top of, on the roof, right?
sure,
And you're only going to replace four of those. You can actually likely expense the cost of all four of those, even
sure.
though they might equate to a $50,000-$60,000 bill.
Wow.
So they look at the unit of property as all of the units together, and you're only replacing four of the 10 or maybe 40%,
Ooh,
and you can expense that cost.
wow. Is that like, so now if you got to six of them, then you would have to capitalize it? Is there like a breaking point there where they're saying like of the 10, now the majority you replaced. So now we're going to say that you have to capitalize that?
Yeah, there's some different terminology that they use in terms of betterment of the unit of property. I mean, I think it in each case it will depend, but yeah, you're on the right path. I mean, there's going to be a review of how how much you've changed that unit of property
Okay.
and basically prolonged its life.
Wow.
So yeah, you're on the right
That's
path.
great. That is crazy. Like even I'm thinking even in my apartment buildings, if I went in and just said like I'm going to replace all these, if I've got a bunch of water heaters or something like that, right? Would that be a similar example where if I just replaced, a third this year, a third the following year, a third the next year, I'd have a better tax
Correct.
situation?
There's a planning opportunity on how you stage and plan out those repairs. Correct.
Wow. That's really cool. See, I love this. Is why I love doing this. Learn something new every time we talk, Jake. That's great. What about like, well, okay, any other thing you want to talk about on the pre side, or like what about we kind of got into as you're
As you're owning.
as you're owning, but is there anything else with as you're owning that you thought of when we were talking about having this conversation?
Yeah, going back to the intent and kind of your holistic picture of you as an investor, big tax items to understand is are you going to be a passive investor, or are you more active in the management and in operating, your portfolio?
Okay.
I think we hear a lot of, there's a lot of a lot of terminology out there about passive income is good income, which 100% would not disagree with that. But when
Yeah.
you're going and actually looking at the tax consequence of that, a lot of real estate investors want to change that passive income to actually be non-passive so that they can maybe take advantage of losses or depreciation, deductions that they can accelerate. So I think, going back to the intent, understanding, what you're trying to get out of your portfolio or your investments or your real estate, and just having that conversation or dialogue with your CPA.
Yeah, I think what you're alluding to and you're starting to dive into is bonus depreciation here, Jake. Is that what I'm hearing?
Yeah.
The
Yep.
eighth, the
Yeah.
eighth wonder of the world when it's at 100%. Right.
Correct. Yeah. When it's at
Yes.
100%, it's
Yes.
it's definitely a very powerful tool. And I kind of let off what gets me excited about generating wealth. I think that bonus depreciation and immediate write-off, can really propel real estate investors, personal balance sheets. You're able to continue to build on what your portfolio is and pay, spend little to no of your cash flow on taxes.
Yeah.
So yeah, it is the eighth wonder of the world when it's at 100%.
Yes, and I want to dive into this because I think even for a lot of people that I talk to on a regular basis here, I'm based in Northeast Wisconsin, as you know, but for the audience, go to networking events, that kind of stuff, and I start talking about bonus depreciation and like people like it is hard to wrap your brain around when you first understand it. And so, uh, like we just had a gentleman who left our company to do real estate full time. It was awesome. I love it. And so now he's flipping and he's got some rentals, right? So he's doing both, which I love
Yep.
that strategy, right? For him, let's just talk through an example of a real life example. I was explaining it to him, but I want the audience to hear from you as a CPA how powerful this could be. So let's just use rough examples. Let's say he makes $100,000 in flip profit in a year, and he's got a building worth $1 million as a long-term rental that he's managing. So he's putting the hours in managing that kind of thing. And we can get into how to qualify for bonus depreciation in a minute, but let's just, for this purpose, say he qualifies to take this, and then we'll get into the details of it after. What is the financial impact for somebody like him if he wants to fully utilize bonus depreciation? And this year, as we're recording this, it's at 60%, correct?
Correct.
60%
Yep.
bonus
Correct.
depreciation. Years prior was 80 and then 100%. So let's just use 60% for this year as an example. And let's see if we can do some, put you on the spot with some math here, rough ball numbers. I'm just going to throw some rough
Yep.
ball numbers around, Jake. And let's see if we can get the audience to actually track with us here now, because this is going to be the challenge. We're going to throw some numbers around. So $100,000 active flip income, $1 million building that worth $1 million, or his cost basis, we'll say, is $1 million on that building. What are the implications for him tax wise
Yeah.
if he's
So
utilizing this?
Yeah, so if you're acquiring $1 million commercial property, right, your general allocation on that purchase is going to be to land and the building.
Okay.
Typically, I think most CPAs would probably tell you their first item to review is probably the assessed value
Okay.
of the land versus the improvements. So let's just say that warrants 20% being allocated to the land and
Okay.
80% being allocated to the building.
Okay.
So of your $1 million now, you're looking at depreciating the 800,000,
Okay.
80% of the
So
million.
we're throwing away the 200,000 of land. We're saying we can't do anything with land.
But
It's not depreciable.
don't
Toss
say
it out the window.
don't say throw it away. It's it's
Okay.
it's still
Okay.
there,
It's
but
still
but it's
there.
not depreciated. So
Yes.
the land component's not going to get recapped. You're not going to recoup the cost basis
Okay.
until an eventual exit or sale.
Okay.
Um, so of that 800,000, let's just say you did, engage somebody to do a cost segregation study on the building. Generally speaking, and I'm just using a percentage here, but generally speaking, based on the different industry or sectors, right? Let's just say 20% of that building is going to get carved out as shorter life property.
Okay.
So, and even backing up a step, the tax depreciation on that 800,000 is going to generally be at 39 years. So
Okay.
when we talk about depreciating and writing off the building cost, it's going to be 800,000 divided by 39 years. So every year for the next 40 years, you're going to get a sliver of that 800 grand
Right on.
as a deduction.
Okay.
And when we talk about cost segregation studies and what that entails, right, we're going to try to carve out different components of the building so that we aren't stuck with that 39-year life on everything,
Okay.
but we might have some 5-year, some 7-year, and maybe some 15-year assets
Yep.
that the bonus depreciation does apply to.
Okay.
Um, so kind of keeping going with our example. So if we have an $800,000 building or improvement cost allocation, let's just say 20% of that gets allocated to 5, 7, or 15-year assets.
Yep.
That's $160,000 that's allocated to those asset classes.
Okay.
And in your example here, where we currently sit with 60% bonus depreciation for federal,
Yep.
60% of the 160 is $96,000.
Okay.
So that'd be a $96,000 federal deduction just for the bonus depreciation
Wow.
piece.
So he would be his federal taxable income would be $4,000.
Yeah, so kind of going to what your example was, assuming that we can immediately benefit from that loss, you were netting the two on your individual return, and yeah, you would be sitting there with a net $4,000 income item.
Wow. What would somebody, let's just use the same example. Let's say they didn't use bonus depreciation, they were just flipping. They're just doing active income, flip, 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 right? What would their tax implication roughly be, not knowing any of their write-offs or anything? Let's just say they have
Sure.
$100,000 on their tax. What are they looking at for having to pay roughly in taxes?
Yeah, so $100,000 of basic call it flip income, right? That's going to be reported on a Schedule C
Okay.
trader business. Schedule C trader business, which is subject to self-employment tax
Okay.
on top of your regular income tax.
Okay.
So if that is the case, on $100,000 of income, you're likely paying 15,000 in self-employment tax on top of, you're going to get 80% times, I would say probably another 17,000 of income tax. So you're looking at 15 plus 17, roughly, 32, $33,000 of federal income tax.
I like not paying that more and holding an asset. So would you say generally the folks that are doing this full-time flip and buying and holding rentals and utilizing this bonus depreciation thing, is that, I mean, if somebody can do that, is that what you would recommend from a CPA's perspective?
Yeah, it kind of goes back to the intent and kind of what you're trying to accomplish. I do think a lot of investors, if they're going to kind of ramp up their portfolio and keep acquiring, bonus depreciation and taking those upfront deductions is a huge tool that allows you to preserve cash flow and buy more deals ultimately. On the flip side, I'd also say, once you have an established portfolio, the deductions, it's a big timing item, right?
Okay.
We talked about the 800,000. It wasn't like you're losing out on the full $800,000 deduction.
Okay.
It's just spread over the full 39 years,
Sure.
right? And investors then start to think about, okay, well, where are rates and where are my deductible items today versus what they will be 15 years from now.
Mhm.
And if you do acquire slowly over time, you're going to build a base of those 39-year deductions, right?
Yeah.
You're as you acquire, that base of what's deducted over 39 years is just going to continue to grow.
Sure.
So I think it does kind of go back to the intent and really your cash flow needs and so forth. But I would agree with your statement that a lot of people, probably in the shoes of our listeners, utilize the bonus depreciation to really jumpstart their investment in their portfolios.
Awesome. I want to get to recapture in a second, but before I get there, let's just clarify for the audience, how does somebody qualify to be able to take bonus? Because you can't just buy rentals and then take it, right? Like, what do
Yeah.
they have to do to be able to qualify for this bonus depreciation?
So the acquisition is gonna qualify, I guess, in terms of bonus depreciation if you're looking at kind of tax regulation. But I think where you're going with that is really the passive and non-passive um, rules, right? So if in general terms and general rule is any rental activity is deemed passive.
Okay.
And the passive loss regulations do not allow a taxpayer to take passive losses in excess of passive income. So
If
if
you're
you
a
just
doctor and you're making 500 G's a year, you can't write off your rental losses against your 500 G's a year is what you're saying.
correct, yeah, if let's just say a single taxpayer in that scenario, W-2 employee at a at a hospital is making that W-2 and they buy one building, that's going to be a passive loss for them, right? Let's just say we get the bonus depreciation. They go through the steps to accomplish that, and they generate a large loss in year one. They're not going to be able to take that loss and offset their W-2 income because that's a passive loss that's going to be disallowed. Now, it doesn't go away, right? That passive loss is able to be carried forward.
Okay.
So it will offset next year's income or the year after, and so forth. So it's it is a
That's
nice way.
income. That's income off of passive activities, right? So stock
Right.
dividends, rental income, but not future W-2 income.
Correct. So it's going to offset future passive income,
Okay.
which it could be from a different rental, it could be from a different investment,
Sure.
and so forth. So it's just really understanding what buckets of income or loss you're gonna be generating,
Yeah.
and making sure that if you can't use them in the immediate year, how you're gonna be able to you know divest and use those, whether it's next year or the year after.
Sure. Cool. Tell me a little bit because we see this strategy all the time, Jake. There's a spouse who's making a really good W-2, and then another spouse who maybe is working but not making a ton. Talk about some of those scenarios and how they can get this bonus depreciation.
Yeah, so similar to your example here with a high-paying W-2 earner, this the rules allow whether the taxpayer or the spouse is able to meet certain criteria to be that real estate professional.
Okay.
That's going to be what allows them to potentially change that passive income or passive loss to non-passive. And yeah, like you said, it is a typical scenario that we see, because going back to even your $100,000 example, paying 30 some thousand in taxes, you can see that number just to continue to climb and multiply. So yeah, it does become a powerful tool to be able to use, whether it's the taxpayer or the spouse, and able to potentially qualify for that real estate professional.
Yeah, we had some another investor couple we were mentoring for a while, and they were making a really good W-2, and their spouse was doing okay. They were making decent money, but didn't really like what they were doing. It was just a job, you know.
Sure.
So when we looked at the taxes and we said, man, for as much real estate as you guys are buying and as much as you make actively over here, what if you just quit your job that you really don't care about and you managed all of your real estate yourself? And now instead of making X amount of dollars at your job, you're just saving that amount of money in taxes and you don't have to work your crappy job. And it was like this light bulb moment for them. They
Yeah.
were like, "What we did?" And like 2 weeks later, she quit her job and hasn't looked back in a couple of years. But uh, those are some
Yeah.
fun scenarios that could play
Yeah,
out in
let
real
me
life.
let me let me let me speak to the kind of the qualifications and
Yeah, yeah,
the
yeah.
items that at least you don't want to just go to your CPA blindly and just maybe ask about it. I mean, it is nice to understand a little bit, where you are at in kind of that spectrum of being a real estate professional or just a passive investor. So there's a couple criteria, to meet to ultimately be able to make that real estate professional election on your tax return. And note again that the big reason you're doing this is to change the character of those passive losses to now make them non-passive, right? So that you're able to use those losses against any of your other income that you have on your return. So the big criteria is you have to be spending more than 50% of your time throughout the year in real estate activities.
Okay.
And I use the word real estate activities loosely there because that doesn't strictly mean rental property management or rental operations.
Okay.
Real estate for that test is fairly, it's not fairly broad, but there's other items that can be included.
Okay.
And one that maybe is a good example is if you own a construction company,
Okay.
or at least a 5% owner in a construction company, that time then counts as real estate activities.
Oh,
So you need you need 50% of your time in more than 750 hours
okay.
during a year for that test,
Okay.
right? That's real estate activities.
Okay.
Once you clear that hurdle, then you're looking at your rental real estate activities and making sure that you can be what they call a material participant
Okay.
in those rental activities. So it's once you get past that 750 hours in more than 50% of your time, then we're going to flip over to another test.
Okay.
And that test is going to be the material participation rules outline 7 various rules that you can hit that test, check the box yes. The main one being 500 hours. So
Okay.
if you think about what we just kind of did, we had 750 hours over here, and now we're
Yep.
doing 500 hours over here in rental real estate activities.
Okay.
If all you do is property management, those are going to be the same hours,
Right.
right?
Okay.
But if you're a construction individual, that's not going to translate to the 500 hours of property management.
Okay.
So it's just kind of understanding what a full year looks like for you,
Okay.
in terms of time commitment, and are you a W-2, are you an owner, are you self-employed, etc. But if you can hit those requirements,
Hmm.
that's where that real estate professional election can be made. And like I said, the main goal is to turn those passive losses, which would have been disallowed, to non-passive and offset your other income
Yeah,
sources.
that could be a big savings every year. Now, the government's always going to get paid unless we die, right? That's the
Yeah,
only way that we can avoid that. Talk about what happens. So I actually had a property that we sold in Florida this year, and we had done a cost seg study, and we had gotten the
sure.
bonus depreciation was 100. If I don't 1031 exchange that into something, what are my tax implications that because I took that bonus depreciation a couple of years ago? How does that
Yeah,
work?
so it's,
This is the
well, let's
downside now. This is the
yeah.
downside of it.
Yeah, so like I kind of commented before, the depreciation deductions are a timing aspect, right? So kind of to Corey's point, if we are taking a big upfront deduction, you can guess that if we sell the property, we're going to have to kind of recoup those accelerated deductions. So it is called depreciation recapture. So based on various asset classes or lives that we talked about, the 5, the 7, the 15, 39, etc. Um, Anything that's 5 or 7 year is going to be subject to this depreciation recapture under one of the IRS regulations.
Okay.
So what that basically is going to tell you is you can't convert what you already deducted as an ordinary item
Okay.
and convert it to capital gain.
Okay.
Right. So the IRS recognizes that we've just allowed you to accelerate a bunch of ordinary income deductions,
Yep.
right, at ordinary rates. And we don't want you to be able to sell that off in a few years and basically say that's all capital gain, which we
Okay.
know, capital gains are taxed at a preferential tax rate, a lower tax rate than ordinary income.
Okay.
So they're going to look to what did you take for accelerated depreciation in that prior year? And how much gain do you essentially have within those 5, 7, and maybe 15-year assets
Okay.
that now has to be recaptured and picked up as ordinary income?
Okay.
So it's the government making sure that we're not converting ordinary income items to capital gain
Right
is
on.
really what the structure of that depreciation recapture is.
So now a way that I can avoid paying that this year is possibly buying enough real estate and doing more cost segs.
Yeah, so a
Okay.
great exit strategy for real estate investors that are looking to continue to build their portfolio is a 1031 like kind
Mm-hmm.
exchange.
Mm-hmm.
So to Corey's comment, if you potentially don't want to, pay any gains, whether it's capital gains or whether it's ordinary income recapture, an easy and effective tool is the 1031 exchange. And the basic mechanics of the 1031 exchange are you're going to relinquish your property that you're selling. The cash or the equity is going to go into a qualified intermediate, an escrow account with a qualified intermediary or title company. You're going to use that cash equity to acquire a replacement property within a stated time period.
Mhm.
And as long as you are acquiring something of equal or greater value and using all of the equity, you're going to actually be able to defer the gain that would ultimately have been generated on that relinquished property.
Okay.
So, throw a simple example. If you had a $500,000 property that you were going to sell, and say we accelerated a bunch of depreciation, we had 250,000 of it was gain. So we would have a $250,000 taxable event with probably some ordinary income and probably some capital gain. If we roll all of our equity into that escrow account with the QI and then acquire something of, whether it's, let's just say we acquire a property worth 600,000 within the 180-day period, that $250,000 gain that we were looking at paying tax on is ultimately deferred into the cost basis of the new replacement property.
Cool.
So you're able to build on your portfolio,
Playing
roll
some
the equity,
Monopoly.
and not have to pay Uncle Sam and come out of pocket for that extra cash flow.
Yeah, no, that's awesome. I love that. And I want to ask you something on seller finance. So there's two questions I have with 1031s and seller financing. Number one, if I'm talking to a seller, let's say, or I am the seller, and I have that exact scenario where I'm looking at, hey, if I sold this, I got a $250,000 gain. Let's say I'm on Social Security, I'm not making much money, right? Is that 250K count to bump me up in all of my tax brackets? That is income. How does that affect all my other income I made in the year?
Yeah, it's going to be, if you are recognizing that gain,
Let's say I'm not
it's
seller finance, I'm just taking it all.
yep, yep. So two comments there. One, it is going to be a capital gain item on your tax return, right?
Right.
If you're recognizing that, it will have, it may have other effects on, like you just commented, Social Security, etc. So you want to be cognizant of what your tax situation looks like and what that might generate. Maybe the negative consequences of recognizing that gain.
Yeah, let's say, yeah, because I'm thinking about this. Like I thought this is how it always worked, and I wanted to ask you this because my thought process: if somebody's later in life, they're not really making a ton anymore as far as like active income or anything, and they're in, let's call it, I don't know, 20% tax bracket, and then they sell off a building. Does that then bump them way up into the highest tax bracket potentially if it's enough gain?
Yeah, capital gain tax brackets are 0%, 15%, and then 20%.
Okay.
So I wouldn't say it's jumping them up to the highest tax bracket. I mean, it is a staggered
So it doesn't
approach.
affect their other income because it's capital gain.
So yeah, the ordinary income piece is viewed separately on what they're
Okay.
paying ordinary income on.
Okay.
Um, but in a situation like that, I mean, you were bringing up the seller finance piece.
Hmm.
So when we talk about seller finance, or in tax terminology, maybe an installment
Yep.
note,
Yep.
you're able to take the capital gain component and kind of marry those up with when the seller is actually receiving payment on the seller financed note.
Okay.
So, kind of to your comment, where I've seen this work out really well is you have a retired married couple that doesn't have much other income, but maybe had this investment property of sorts, right?
Hmm.
And we know that as a married filing joint taxpayer, they can basically pick up $80,000 of adjusted gross income. And if that's all capital gain in nature, they actually would pay zero tax, because that 0% bracket for capital gains is up to up to that threshold.
Wow.
So we're able to kind of look at what a seller note or installment note might generate for them, and try to target how much capital gain those individuals are ultimately recognizing in a given year,
Wow.
and hopefully then not pay any capital gains tax on that sale.
That's
So
crazy.
yeah, it can be a powerful tool in understanding where their other income really lies.
Wow. So if let's in that exact scenario, this guy's popping around selling it maybe. The benefit for me as a buyer to offer to the seller is up to 80,000 a year in payments, and there's no tax on it.
So now the correlation between the payment to what the actual gain is. So there is a
Okay.
computation that's going to look at what the overall sales price is for the property
Okay.
relative to the gross profit or the gain.
Okay.
So in an example here, if we were to sell $100,000 property, that the gain was going to be 20,000, right? That's a 20% gross profit margin. So for every dollar, if they sell or finance the whole 100,000 for you,
Yeah. Yeah.
so for every dollar that you receive or they receive, 20% of that's going to be their taxable portion.
Okay.
So it's just understanding what that gross profit margin is and every dollar that they receive, what that actually means to them in terms of taxes.
Okay.
One thing I do want to go back then and touch on though is if you have an installment note, ordinary income recapture, so our whole depreciation recapture that we talked about, cannot be deferred on an installment.
So they still are going to have to pay
So it's kind of a
tax.
trap. Yeah, there's potentially a
Interesting.
trap, a kind of a trap for the unwary there is if, your seller has taken all these accelerated benefits on depreciation, they're going to have to make sure and understand what that looks like if they were to sell or finance the whole deal. Because there could be a scenario where, let's just say you guys agree to not paying any principal payment for, 12 months.
sure.
And they could be sitting there holding a tax liability because they have the depreciation recapture
Yeah.
that doesn't get deferred and you not have paid them any cash yet. So it's just making sure they understand that the capital gain portion is all that can be deferred on an installment sale. But
Okay.
still a very great tool. I've seen used quite a bit. Um, it's power. Yeah, it's another powerful tool when you're looking at exit strategy.
I love it. So, in your opinion, is it best if like buyer seller talk to their CPA if they're trying to structure something? You know.
Yeah, 100%. I've advised I think some individuals on your team before
Sure.
about that same thing. When you're talking to sellers,
Yep.
you definitely don't want to get them. You want them to understand and talk with their CPA or some
Mm.
professional in their lives to make sure that you have all the facts. Just because you might not understand what they did from a depreciation standpoint,
Yeah.
in the past.
Oh, that's really good. That's really good to know. On that same note, I actually have a scenario right now I want to run by Jake. So we've got a potential 1031 exchange into a property. Okay. We would like the seller to give us some cash back for rehab on it. Is that possible in a 1031 or is that an IRS no?
So you want cash back outside of not just being a purchase price reduction? Is that
Yeah, so what we're kind of starting to think about is like, how can we make this deal work for them? Because they want a higher price than we want to pay, right? So I'm like, well, there might be a way we could do it if they would sell our like we could 1031 probably, let's call it half. Like, so call it $400,000. We could get them from some sales of some properties. Let's say he wants 800 for it, but it's going to be 100,000 in rehab. What we're saying is like, hey man, how about you seller finance the other 400 and then get us a credit of 100K back, or we'll give you 900 for the property. You give us 100K credit at closing to do the rehab, and we'll take 400 of our 1031 and put it down on the
yeah?
property.
So that way the transaction is going to work, because you guys are your scenario is you're relinquishing of properties that are going to bring 400,000 to the table,
Yep.
right? And you're going to roll all of that equity
Yep.
into this new property that's $800,000 or $900,000,
Yep.
right? You're going to have to backfill the additional equity or loan, right,
Yep.
to acquire that upside.
Yep.
So that transaction works
Okay.
seamlessly. What
Cool.
I always caution people is just understanding that they can't take if they take cash from the relinquished sales,
Okay.
that part's going to be deemed taxable.
Yeah.
So
No, we would
we
roll
just
it
want to
all.
be yeah we just want to be cognizant of what that looks like. That they're rolling all the equity, etc.
Okay. Cool. Well, that's good. That was one thing we just thought of as a way we could potentially still make it work.
I,
And
I, I do want to note that we've seen a lot of what they call improvement exchanges.
okay.
So it's same concept, 1031 on the surface, right? You
Yep.
sell a property and acquire a property, but on that acquisition, let's just say you were going from that 400,000 and you were only acquiring into something for 300,000, but you knew it needed that extra 100,000 of improvements.
Yeah.
So when we talk about an improvement exchange, you could encompass the outright acquisition of 300 plus identify the 100,000 of future improvements. Now they do have to be done within that 180-day window,
Oh,
but
okay.
it's a nice hey, I'm already going to be spending this money when I acquire it because I
That's
need to
awesome.
whether it's build out, tenant improvements, you name it.
Wow.
It's an easy way to still capture those items within the 1031 exchange.
That's awesome. I love that idea. That's really cool. I had no idea you could do that, but that's huge. I mean, it's great for us burr investors out there. Now, what about refinancing a 1031 exchange? So let's say bought a property for 250. My 1031 was 240,000. I paid 10 grand of cash for this new property. Now I want to pull all that equity back out of there and go use it for something else. What's the rule or the guideline you would give somebody on something like that?
Yeah, so the IRS regulations don't fully address how the refinance is going to be viewed.
Okay.
But I would say in practical client interaction, what we've discussed is, kind of waiting till after that exchange is completed,
Oh, sure.
and giving it some time to season,
Okay.
so that when you do refinance, a month later, you're not the IRS can't collapse that transaction and
Okay.
be essentially viewed as one.
Okay.
So we would just want some time period to lapse after you close out the exchange
Cool.
to
So there's no
ultimately
set
refinance.
rule on that or anything. Okay.
Nope.
Okay. Well, that's good to know, man. Last thing I'll touch on here quick, Jake, and then I don't want to keep everybody too long here, but there's so much we could probably sit here all day and talk
Yeah.
this stuff. Just a real quick thing. You mentioned early in our example of the $100,000 flipper and having to pay self employment tax. How can they avoid that? What's the structure they could use to avoid that?
Yeah, so self-employment taxes view this as anything that the taxpayer is generating in terms of income, right? And net income after expenses. It's basically the payroll taxes that the equivalent W-2 pays, right? Or
Okay.
have withheld from their paycheck. As a self-employed individual, you're on the hook for both the employer and the employee portion.
Mm-hmm.
So you do get a deduction later on your tax return, but I talked about 15.3%. I mean, that's the FICA, your Social
Okay.
Security, Medicare items that you're going to be on the hook for every dollar of net income.
Okay.
So a lot of people out there use S corporations as a potential tax planning strategy on how to avoid self-employment tax.
Okay.
And two things on the S corp is you do have to have other people that are generating the income for you.
Okay.
So what you wouldn't want to see is, just a sole proprietor that is out there, generating revenue all by themselves. They have no team underneath them.
Good to
You're
know.
going to have a hard time arguing to the IRS if you're just the sole owner and you make an S corp election, and now all the income is the same, right?
Sure.
And now you're just pulling the income via tax-free distributions rather
Okay.
than having that income be taxed at the self-employment tax. So, I mean,
Okay.
there's a lot of variables that would factor into that, but you definitely want to review with your CPA how the S corp may benefit you. You do have to then the other item I was going to mention was if you do become an S corp, you do have to pay yourself a reasonable comp,
Okay.
right? So you, Corey, are the sole owner of an S corp that has 10 employees. we still need to pay Corey a W-2 for his services and the value of what he's bringing to
So
the
you're
S
still
corp,
paying some payroll tax.
because that's going to be ultimately what you're paying payroll taxes on.
Got it. Okay.
So, but the larger the income number within an S corp, that self-employment tax, you're escaping it.
Okay.
And yet one other thing I'll note is there is always a cap on the overall Social Security that you have to pay in every
Okay.
year.
Okay.
I think this year it's probably, I think, 170 some $1,000. So
Oof.
once you're making over $170,000, you're not paying the
Oh,
full
okay.
15.3% anymore. It's going to only be the Medicare piece. So I mean, if you always know the incomes above that, there may be some risk that we don't need to take. Understand where you're ultimately at with your self-employment income. So
Ultimately, get a good CPA, sit down and discuss all this stuff. Even if you're just starting out, that was one of the best pieces of advice we ever got was, hey, get a real estate specific CPA if you think this is something you want to do for a career, and start planning before you have a problem.
yeah,
Get ahead of
I
it,
think
right? Get ahead of it.
100% agree. And I think if you look at real successful investors out there, you see that they have, they understand the full picture. They probably have the professionals, on their team as well.
Yeah,
But they know how to present that to lenders, right? Which
sure.
allow you to continue to grow and, have your personal financials in order and understand what that looks like for you. And yeah, you start building out systems and processes with your team. Um,
Mm-hmm.
yeah, it'll take you a long way and really create that wealth that you're looking to generate.
Absolutely. All right, Jake, last question we ask on the podcast. What is your favorite place to visit in Wisconsin, or favorite Wisconsin tradition?
Favorite place to visit? Every year we go up to Eagle River
One of my
with the
favorites.
family. I think the chain of lakes it's a cool atmosphere up there. The kids can relax, kind of get that outdoors time the whole week. And I think sometimes at home we get stuck just running around to different things, and you don't just sit back and relax. So yeah, I would say that's my favorite place and really favorite tradition that we've been doing for the last 5 or 6 years here.
I love it, man. That's like my heaven on earth. We travel a lot, and I always say that's one of my favorite places, no matter where we travel. Eagle River, Minocqua area, northern Wisconsin. It's tough to
Yeah,
beat, man. It's tough to
yeah,
beat. Well, guys,
agree.
thanks so much for checking out this episode. I know we went a little long today, but there was a ton of information here. Jake, I appreciate all your time, man. If somebody wants to get a hold of you or talk tax planning about their stuff, what's the best way for them to get a hold of you, Jake?
Yeah, you can reach out via our website, claconnect.com, or my direct line number is 920-455-4232. So look
Awesome.
forward to it.
Beautiful. So, guys, if you enjoyed this episode and you want to learn more about just real estate investing in general, just go to our website, wisconsindiscountproperties.com, fill out a little contact us form, and somebody from our team will reach out. We would love to try to help you get started in real estate here in Wisconsin or expand your current Wisconsin investing goals. Again, this is another episode of Wisconsin Investor. Thanks for tuning in, and we'll see you on the next episode.